Hey, hi friends. Warren Buffett, he just finished his AGM, I think about a week ago. I will summarize the entire 4 hours meeting and I give you my take behind Warren Buffett. So this guy, he trailed the S&P 500 for the last 5, 10, 15 years. Ouch. He was actually asked this question during a Q&A and I really cringed for him. I will also cover why, in my opinion, value investing is dead. So firstly, I will need to define what is value investing, so let's go Google it. What is value investing? On the top of the search, Investopedia. What is value investing? Value investing is an investment strategy that involves picking stock that appears to be trading for less than their intrinsic value or book value. I'll explain this later. Value investors actively ferret out stocks, means they filter out stocks which they think the stock market is underestimating. So this is what it means. Value investors like discounted stocks, things which are cheap. Because things are discounted, they swoop in for the discount. I'll show you roughly how they do it. So we are looking at this thing called book value. So there's one method where we can do stock screening is we go to Finviz. You go finviz.com, is free, this screener. So there's many tabs here. You go to screener here. And what you need to do is, because you are a value investor, you click the fundamentals of a company. And there's this thing called P/B, which is price to book ratio. Okay, so basically for a value investor, their criteria, it has to be like around under 1, which is good. So anyway, if you look at the results that come out, there are about 1,900 companies which has a book value of less than 1. So inside the top few, which have over here, you see a lot of familiar names. We have Berkshire, is number 1 here. We have ExxonMobil. You see a lot of financial companies. You see a lot of oil companies. You see a lot of banks. Basically, mostly financial industry, which is the banks and energy companies. Maybe let's go page 2 and see what we see. Again, financial and energy, it goes on. Maybe one in the middle, tomato ketchup. We also see car companies like General Motors here. And I think on the first page, we saw Toyota. So this is how value investors, they search for discount and they swoop in for the stock because it's cheap. By the way, I'll really appreciate your effort for helping me click the like button. It really helps a lot for the YouTube algorithm. It pushes out the video to more people. So what is price to book? I'm just going to put it very simply. Let's say the company is worth $1 million on the stock market and the company owns like $1 million worth of machinery. Maybe this machinery is used to produce items. Okay, so $1 million worth of assets and the company is worth $1 million. That is price to book of ratio 1. Usually on the stock market, the price to book ratio is above 1. So suddenly, let's say we have a few companies where the price to book ratio drops below 1, it is cheap. Let me give you an example. Let's say, for example, the same company has $1 million worth of machines making products. And one day the company, the value drops to 800,000. That gives us a price of book ratio of 0.8. With the price to book ratio of 0.8, you are effectively buying the company at $800,000, but you are getting $1 million worth of equipment. The biggest problem with that is what's valuable to this company may not be valuable to another company. And let's now talk about some examples. Remember when Tesla bought over, I think, the General Motors factory, there were a lot of car equipments inside there. The thing is, whatever General Motors use to produce the car is worthless to Tesla. So those equipment are practically worth nothing. Or let's put another example. Let's take banks, since there is a lot of banks inside this discounted place here. So banks, how they calculate price to book ratio is basically the amount of assets they own, blah, 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 so on. So they maybe include property and some companies. You see, when a bank goes zero, goes bankrupt, let's say for example, this current property will be on forced sale. That means they will auction out the property. It may not translate to what it is on the actual paper itself. And let's say if the banks owns companies, even worse, the company's equipment is almost zero because it's worthless to another company who may want to take over the company assets. So again, price to book ratio is very, very skewed. Not on paper it seems good because whatever you can value the item, there's a value to it. But the biggest problem is when it actually happens, when a bankruptcy happens, you are not going to realize the actual value in the price to book. Don't get me wrong, I super respect Warren Buffett. He taught me plenty, and there are things that are still relevant. But most things is outdated. Times change, things change, and most importantly, we grow and learn. Since we are talking a lot on the banking and financial industry, let's use the banks as an example again with the lack of growth and innovation. You see, there's close to zero innovations in the banking sector. If you look at China, on how everyone, including the beggars, are using like their mobile phone for digital payments, everybody is doing it. One day, somebody is going to come along and innovate past the other banks all around the world. Digital payments is the place to go in the very future. You do not see traditional banking moving into the digital sector where they will help out with payments. I think this is going to be the next disruption. Anyway, I began to ask myself, what ensures the company's growth? I began to ask myself relevant questions. You see, copyrights and patents won't protect a business. It never will over the long term. There is only one thing that protects a business, which is innovation. You keep innovating and your competitors can't keep up. What Warren Buffett does is look into boring, simple businesses. Yes, they may have some kind of economic moat, but if they fail to innovate, one day somebody is going to come along and disrupt them. Let's cover what I disagree first. These are the points which I disagree with Warren Buffett inside the AGM. He says to buy a cross-section of America and forget about it. He basically means buy the S&P 500 and forget about it. S&P 500 is the index of America, so when you buy into the S&P, you buy into 500 companies. I disagree that because the thing is, there's this thing called value traps. Like just now you saw within the screener itself, there are oil companies. It's like catching a falling knife. A knife is falling and you want to catch it. That is like super dumb. The thing is, investing in index, overall, I do agree that it's kind of safe. But within the index itself, there's a lot of value traps. And to me, if you are an educated investor, I would probably like to nitpick on the companies which I think is amazing and avoid all these other value traps. The next point is that Warren Buffett sold in April. April was one of the best months for the stock market. It is crazy. I don't agree with him. Actually, I did a video on this, on why I think the market will keep going upwards. I'll link it up here and I'll put it in the description below. But he sold in April, which the markets went up like one of the most bullish times in the stock market. And he did the exact opposite. This is the oracle of investment, the number one guy in the world, and he sold in April, where I was telling everybody to buy. Warren Buffett increased his cash position to 130 over billion. I think it's 138 billion in cash. Hello? The central banks of America, the Fed, they already said that they will print unlimited money and do whatever it takes to support the stock market. Why are you keeping all that cash? You see, all that cash is going to go into the bond market and generally spread all around. Eventually, all this cash will trigger some kind of inflation. And I actually did cover again in my past videos that this inflation will occur in the stock market. Warren Buffett also said that the airline's CEO was doing a great job when he purchased into the stocks. I mean, hello? The airline CEO, now we all know this whole thing about CEOs doing the share buybacks is a stupid idea, and the thing is, he's still defending share buybacks. That is so old school thinking and very, very irrelevant. The reason why money goes into share buybacks is that because the CEO doesn't know what to do with the extra cash. This is what he is practically telling the world. Hey, I don't know what to do with my extra money. I will just do share buybacks. Again, I couldn't disagree more with Warren Buffett. I believe the extra cash, if you could use the money, should go into innovation. And again, either you innovate or people will disrupt you. Now let's go to the part where we agree. Okay, so he said two things which I totally agree. So the first part is never bet against America. I totally agree that. And Americans and America, you guys are so innovative because of your culture and stuff. The things that you come out with, the rest of the world copy, especially freaking China. So the thing is, I do not want to bet against America. The S&P 500 has been going up for the past 140 years. I am quite certain it will still go up at least in the next 10 years. Yeah, I have nothing else to say on that. So the next point, he sold all airlines. That is a good move. You realize when your investment thesis is wrong, sell. You have to do that. You cannot like keep hoping and hope the stock go up. Hope is not a strategy. And of course, the last point, I agree, and I showed this in my previous video. You see, this is what he said, and I really 100% agree with him. I couldn't agree anything lesser than him. When you buy a stock, you should be prepared financially and psychologically to hold them. You have to be prepared to buy a stock and have it go down 50% or more and be comfortable with it. So let's say, for example, you buy a stock and it drops 50%. You have to be really comfortable because of this thing called, you did your research, you know exactly the company, what their outcome is in the future, and the stock market is being stupid. You have to be mentally ready for this. Okay, you see that he said, if you can't handle this psychologically, you shouldn't own stocks. This is the thing. This is something that I teach all the time, and you have to understand that whatever he said, the reason why an investor like me and a lot of successful investors, we are able to be level-headed when shit happens is because the amount of work we put in. No amount of money can buy that kind of conviction that I have in Tesla and the stocks that I buy. Concluding this video, what we learn in the investing world, we can apply to our daily lives. People who are willing to keep learning, growing, and generally have a positive mindset will do better. Hey look, I don't mean to ask you to be positive one day. It's not a one-day thing. It's a long game that we play. You see, Warren Buffett is a legend, but like all legends, if you fail to innovate, you will be left behind. Just like Berkshire Hathaway trailing the index for so many years despite tons of resources. There is no excuses for that. Appreciate those who helped me with the thumbs up. You guys are really awesome. Invest safe.